What happened to my cash flow? Have you noticed something strange? The interest rates are sticking up and they're not budging at all. The White House has replaced the Federal Reserve chair, but it is just not helping people like us, the investors. Interest rates affect everything. As an investor, cash flow is our oxygen. Without cash flow, our business would die. I don't want our business to die. No, the monthly payments are directly proportional to the interest rates. Higher the interest rates, higher the monthly payments, and higher the monthly payments, lower the cash flow. Just a few years ago, people were buying houses faster than they could hit the refresh button on Zillow. Homes were selling for way over asking price. Buyers were waiving inspections. Boss, never do that. Some people even bought homes without even stepping inside. Back then, even if the homes were expensive, the 30-year interest rates ensured lower monthly payments. So the investors were happy because the cash flow was there. Fast forward to today, and the method is completely changed. Mortgage rates are much higher. Homes are sitting on the market longer. Sellers are cutting prices in many cities, and even after all these discounts, investors are just not jumping into the pool. No, they don't want it. Why would you buy an investment home with a higher interest rate and a lower monthly cash flow? I definitely wouldn't. No. And everywhere you look, someone is predicting either a massive housing crash or another housing boom. So who's right? I don't know. Is the housing market about to crash? Or is everyone looking in the wrong direction? What about my damn cash flow? Because here's something that almost nobody's talking about. The future of the housing market may have less to do with your neighborhood and much more to do with government debt, tax collections, global politics, and even the US dollars. Yes. Now, before you click away thinking this is going to sound like an economics class, don't worry. I'm going to explain all of this using simple language, because understanding these forces could save you tens or even hundreds of thousands of dollars if you're planning to buy your next rental property soon. And towards the end of this video, I'm going to share the one indicator that I watch more closely than home prices themselves. Most investors completely ignore it, yet it often tells you where the market is heading before everyone else catches on. So stick around. Hey everyone, if you don't know me, my name is Vikram Chopra. I was an investment banker and a broker in the Greater Charlotte metropolitan area, where I live and invest and help other investors reach their financial goals through real estate investing. And today I'm at the airport. Let's start with the question everyone is asking. Will the housing market crash? The honest answer is probably, but probably not in the way most people expect. When people hear the word crash, they immediately think of 2008. Prices collapsed, banks failed, people walked away from their homes, entire neighborhoods were filled with foreclosure signs. Man, I remember those days. I used to live in New Jersey and commute to New York for work. I used to drive by this big office building that had 1 million cars parked outside before taking the train. One day, the entire parking lot was empty. I was shocked beyond words. But here's what many people forget. The reason for the 2008 crash wasn't simply that homes were expensive. It was that millions of people had loans they could never really afford. The bankers were greedy. Banks were handing out mortgages with very little verification. Adjustable rate loans reset to much higher payments. When borrowers couldn't pay, foreclosures exploded. That created an enormous wave of forced selling. Today's market is different. Most homeowners have fixed rate mortgages at historically low interest rate, all thanks to COVID. In fact, when COVID hit, I was ready to gobble up more than 20 homes. Yes, I'm not even kidding. I lived through 2009. I know the cash flow and the inbuilt equity when you get a home that has been foreclosed. And you know what? I just waited and waited and waited more, and nothing happened because the government floored the interest rates. Boom! Off goes my dreams of owning 20 more homes during COVID. Bye-bye, adios. In fact, many homeowners have a mortgage rate that is less than half of today's rates. Think about that. If you borrowed money at 3%, would you rush to replace it with a loan of 7%? Probably not. That's one reason inventory has remained relatively tight. But here's where things start to get really interesting. Even if homeowners don't want to sell, something else can still put pressure on them. And it's happening. And that is where government debt enters the picture. A 1% increase in the mortgage rate can raise your monthly payments by hundreds of dollars. Can you believe that? And that means fewer people qualify for the same house, and investors like you and me see our cash flow disappear. Keep that thought in mind because it's about to connect with something much bigger. The United States government spends an incredible amount of money every year. Some of that spending is covered by taxes, the rest is borrowed. Think of it like a family. If a family earns $100,000 but spends $130,000 every year, eventually they have to borrow the difference. Governments work differently from households in many ways, but the basic idea of borrowing still applies. The US government sells Treasury bonds to investors around the world. When someone buys one of these bonds, they're effectively lending money to the US government. Here is why that matters to you as a real estate investors. Mortgage rates don't appear out of thin air. They're heavily influenced by the Treasury yields. If Treasury yields rise, mortgage rates often rise too. And if mortgage rates rise, people cannot afford houses. My cash flow takes a dip. Suddenly, a buyer who could afford a $500,000 home might only qualify for $420,000 home. Nothing changed about the house. Nothing changed about the neighborhood. The financing changed because the government wanted it that way. That's why interest rates are so powerful. But now comes the next question. Why would the Treasury yields rise in the first place? Well, one reason is inflation. Another reason is the sheer amount of government borrowing. If investors believe the government will continue issuing large amounts of debts, they may demand higher returns before lending more money. Higher yields, higher mortgage rates, and lower affordability. See how everything starts connecting now? By the way, if you're a beginner or an investor and are looking for guidance on how to get started in real estate investing, feel free to book a 20-minute phone call with me. Link will in the description. We can go over your deal together. Now let's bring in taxes into our conversation. These property taxes are killing, man. I'm telling you. Even if you, my investor friend, have fixed interest rates mortgage, the property taxes is variable and almost every year it goes up. Most people think taxes only matter in April. Real estate investors know better. Taxes affect nearly every decision in the housing market. Property tax, capital gain taxes, income taxes, depreciation rules, interest deductions, local government budgets, infrastructure spending, even zoning decisions. Here's something many investors overlook. When governments collect less tax revenue during slow economic periods while continuing to spend heavily, they often need to borrow even more. Again, more borrowing can contribute to upward pressure on the interest rates depending on broader economics and the broader market conditions. Notice how everything keeps circling back to financing. Housing market just isn't about houses. It's about the cost of money. And that's exactly why investors who only look at listing prices often miss the bigger picture. That's why even small interest rate movements can reshape the housing market. Now, here's where things become more global. Most people think housing is purely local. School districts, crime rates, growth jobs, populations, those absolutely matter. But there's another layer that most people never think about. Geopolitics, wars, trade disputes, tariffs, energy prices, international investors, central banks. These events may seem completely unrelated to your neighborhood, but they often influence inflation, financial markets, and ultimately interest rates. And all of this kills my cash flow, which I'm not happy about. Imagine oil prices suddenly jumping because of a major conflict. Transportation costs rise, manufacturing costs rise, businesses pass those costs to the consumers like us, you and me. Inflation can and will increase. Haven't you noticed lately? The hood that goes on top of a stove is now sold for $89. Back in 2011, when I started in this business, I got the same hood for $37. The cheapest caulking tube is now $4. That used to be 30 cents. Central banks may respond by keeping the interest rates higher than expected. And once again, mortgage rates can stay elevated and my cash flow starts dying slowly. Notice how many different roads all lead back to the same destination. The cost of borrowing. That's why experienced investors spend time understanding economics, not because they want to predict every headline, but because they want to understand the forces that shape financing. That's why if you're planning to invest money in real estate, go ahead and book that free 20-minute call with me. We can discuss your situation together. And There is one historical relationship that often comes up in these conversations: the petrodollar. The oil and gas from the Middle East has so much impact on our lives and cash flow that it's unbelievable. But it's actually much simpler than it sounds. For decades, much of the world's oil trade has been conducted using US dollars. That created a consistent international demand for dollars because countries needed them to buy energy. Many economists argue that this broader global demand for dollars also supported demand for US Treasury assets, including the Treasury securities. Why does all that matter? Because strong demand for Treasury securities can help keep the government borrowing costs lower than they would otherwise might be. And if borrowing costs stay lower, mortgage rates can also benefit over time. But what happens if the global financial landscape changes? What if more countries diversify how they trade or hold reserves? What if international demand for US debt evolves over the coming decades? Could that affect borrowing costs? Could it influence the mortgage rates? Those are all important questions. But what can we do to ensure that our cash flow is healthy? Isn't that the goal? Well, to start, buy homes with inbuilt equity. These are at least 20% below the market price. Go to the local courthouses. Buy foreclosures. Don't buy expensive homes. If need be, watch my video here on how to buy homes that are out of state. You can often find homes that are a bit cheaper, about 50 to 60 miles away from any major city. If these global forces continue to unfold, which housing markets are actually at risk and which ones could still outperform even if the national headlines turn negative? All these are part of a much bigger story that we'll look at it soon. That's why if you have questions, doubts, concerns, go ahead and book that free 20-minute call with me. And remember, we cannot control geopolitics or interest rates, but we surely can do something on our part to get a better rate when purchasing our next rental. And that something is improving our credit score. Every 100-point improvement in credit reduces the interest rate by 5 basis points, which definitely improves our cash flow. And is that not what we all want? So go ahead and watch my video on how to improve your credit score from 600 to 800. Until next time, this is Vikram signing off. Good luck, goodbye, and go earn your freedom, even if the government keeps borrowing more and more and more money. Let's start a revolution. Long live freedom. Freedom from poverty, freedom from bad bosses, freedom from anything that stops us from building our business.